All right, so which should we really be using infinite banking to pay off your debt? What are the good types? What are the bad types? How do you know if it's really the right thing to do? Because there are a lot of myths and lies that are taught to you, even on YouTube and Instagram. Not on our channel, of course, but on other ones. But you'll see those lies, so I want to dig into what those are right now. Okay, so you're looking at infinite banking to pay off debt. And I don't blame you because it's been taught and sold so many places, right? They tell you instead of using the bank, go and use this, use your infinite banking policy. You'll pay yourself back, right? You ever heard that? Yeah, I did too. About 20 years ago, when I first heard about infinite banking, I'd never heard about it as a financial advisor, did that for 4 years, and then all of a sudden, I meet these real estate investors, they say, you should look at this infinite banking thing, it's really cool. So I go and look into it, and I'm still like, okay, where's the cool part? But I read the book by Nelson Nash called Be Your Own Banker. Great book, by the way, good basic stuff. Some of it is outdated, and that's part of the issue. And so he talks about the examples of instead of going to the bank to get a car loan, instead use your policy, the cash that's from your policy, not your death benefit, but the tax-free savings account inside the policy, specifically whole life. Use that to then go and buy your car outright in cash, and then you pay yourself back, right? That's what they always say. I'm going to tell you this. There's some half-truths that go along with that, and it may not always be the best strategy. Because here's what I learned later. So I thought the same thing. I'm like, oh, this is no-brainer. But I remember like one of the guys I used to work with back in the day, his name's Garrett Gunderson. He wrote the book Killing Sacred Cows. He's also a proponent of this too. He was on the radio debating a real estate investor. So I was excited for this debate. I thought this is going to be cool. And then they started debating, and the real estate investor just blasted him out of the water because he couldn't really explain how it was any better. He didn't even offer to say, here, look at these numbers, here's what we do. No, he didn't do any of that. Because the truth is, he didn't even know. And then they kept going back to like, what's your human life value, yada, yada. No, it's not, nobody cares about that. When you're an investor, you want to play good offense, right? You got to have a good offense. Yes, we know you have to have a good defense too, but the offense can't be sacrificed for that defense. So anyways, I had heard that stuff. He even talked about using it to buy his car and things like that. Well, as I start to learn more about it, I started to realize, wait a minute, I'm literally getting a loan from the insurance company. In the same example of what he was talking about, I'm getting a loan from the insurance company. Well, isn't that like getting a loan from the bank? And when I asked different people, they said, well, this is kind of like for those Dave Ramsey, like diehards, right? Just the people that are just like, the extra judgmental people, like not just the Dave Ramsey fans, the diehards, and they're always anti-debt for everything. So like, no, do this instead. I'm like, okay, yeah, you're leveraging your own cash, but you're still just getting a line of credit, a debt against your cash, right? And then I got this big aha, is when somebody finally told me, they said, listen, you're always paying interest. Whether you're borrowing money from somebody else or whether you have money in savings, but then you use it to buy something in cash. You lose the ability to earn interest on that money, don't you? Because think about it, if you buy a car out in cash, yeah, you don't pay interest, but now you're no longer earning interest on your money in that savings account. It's gone, it's out of there. And I said, okay, now I'm starting to see this. So really the debate is, where do I make the most money? Borrowing it or making money with it? But then I realized this, is that when they say pay yourself back, another lie you hear with infinite banking and paying debt, you do not pay yourself back. What you're doing is you're borrowing that money from the insurance company. Now your money's still in there, growing, earning tax-free compounding interest. That's awesome. But when you borrow money from the insurance company, even though they don't have a monthly payment that's required to pay, still you're being charged interest that goes back to them, not to you, not into that account, it goes back to them to pay down that line of credit eventually. You pay down principal and interest. As you pay down the principal, you free up the cash over here to use again if you want to use it again. So really, if you're getting charged, say, 6% a year on that loan, well, guess what? What if I can get a 4% mortgage? That may not be today, but a couple years ago, I got a 2.75% jumbo loan. Do you think I'm going to go and try to pay 6% to an insurance company when I can get 2.75% from the bank? Even more so, it's not my money. I'm still borrowing that money from the bank while not touching my money over here. Same thing with a car loan. I got a car loan last year for 3.99%. Even though the rates were like 8% or 9%, I was offered 3.99. I took it because I said that's dirt cheap, and I was not going to use my policy to pay 5.5% to 6%. No, I did that because I know that I'm paying interest to somebody one way or the other. Which one's going to give me the best? Now, here's the thing. I'd rather use the bank when the money is cheaper. Even if it's not the lowest interest rate, even if they're the same, I will still always go for the bank. Why? Because I'm using their money. If I'm going to use my money, even when I'm borrowing from the insurance company, I'm literally accessing the money that I also have over here, right? Well, if I'm going to use that, I'm going to use it for things that the bank won't give me money for. So I'm going to use that for things that do pay me higher returns, like investing in real estate. So for example, I don't go buy a property and buy it 100% with my cash from my life insurance. No, I will get the 80% or 75% mortgage from the bank, for the mortgage, and then the other 20 or 25% for the down payment that I can't get a loan for from the bank. I use that for my policy. That's how I do it. I leverage the bank for the cheap money that's typically in the single digits, and then the money I won't get from the bank, I use for my policy. Now, if there's a choice between using a credit card or using my policy, yes, I will use my policy. That's the difference. So I personally don't use my policy to pay off debt. Even when I've had clients that do have debt, if they do have debt, I might say, well, pay off this credit card. But here it comes down to this question, because a lot of these infinite bankers, they'll say, well, set up a new policy, then you can pay off your debt. Well, here's the problem with this. Say you're going to try to put in $20,000 a year into this policy. That first $20,000, even if they give you a good policy, you might have $16,000 in that first year you might be able to use. Well, that means $4,000 goes to cost, giving you $4,000 less to use to pay off your debt. So I told one client, they said, yeah, I know you're going to say use my infinite banking policy. I said, you don't know me that well, because I'm an investor first and foremost, not an insurance agent trying to sell you more crap, okay? So I said, no. Instead, I'm going to tell you to take that money you have, pay off all your debt, free up that $1,000 a month of debt, and then you can use that $1,000 a month to then start a policy. Then you can build into a policy. He's like, well, wouldn't I just use the policy, pay off debt? They say it's all better. I'm like, it's not. I'm like, you're still paying interest back to the insurance company. So you still have that quote unquote debt, so to speak. You have a loan outstanding. Sure, you won't have a monthly payment and it will improve your credit score. That is good. It's not the worst thing in the world. But no, save that extra few $1,000s and use it to pay off these loans, because you got way more than that. And then do that, and then we take that money as you start to improve your cash flow and you have more money to put in, then you can start saving more into a policy, which will even be a more productive policy anyways. And so that's the thing, guys. There's these little nuances and things like that. Yes, if it's paying off for credit cards, it could make sense. If you already have a policy and it's already paying for itself, or it's already at the point where whatever you put in can come right back out, that makes sense. But if you're looking to start a new policy to pay off debt, don't do it. I would say don't do it at all. There's better ways to do it. Now, there's always nuances. There's always exceptions to this rule, right? It's never, never. But I would say for the most part, most of the cases, we would say don't just use your policy to then go pay off debt. Just pay off the debt, then use the money you saved to then start the policy. So if you want to see what could be good for your situation, just go to moneyripples.com. There's an insurance infinite banking section right there. You can actually even book a call with an agent to find out what works best for you right now.